Banks were built on one promise: your money is safe, available, and unquestionably yours. That promise holds only during calm weather, when confidence flows faster than withdrawals. When storms arrive, the legal definition of ownership quietly changes without your consent. Most depositors never read banking law because stability made reading unnecessary for generations. Yet buried inside modern regulations lies a switch designed for moments of financial panic. That switch is called a bail-in, and it changes everything about deposits overnight. A bail-in is not a theory, not a conspiracy, and not an emergency improvisation. It is written law in many advanced economies, prepared long before crises begin. Unlike bailouts, bail-ins do not use taxpayer money to rescue failing financial institutions. Instead, bail-ins legally redirect losses onto those closest to the bank's balance sheet. That includes shareholders first, then bondholders, and finally large depositors. In extreme conditions, depositors become involuntary participants in saving the banking system. The logic is simple and brutal. Deposits are liabilities, not vault property. Legally, your bank balance is an unsecured loan you made to the institution. You do not store money in a bank. You lend money to it. During normal times, this distinction feels academic, harmless, and mostly irrelevant. During crise becomes the most important financial fact of your life. To understand why bail-ins exist, we must revisit the aftermath of 2008. The global financial crisis shattered trust in banks. Regulators and political promises simultaneously. Governments spent trillions rescuing institutions deemed too large to fail safely. Public outrage followed as taxpayers absorbed losses created by private financial risk. Politicians vowed never again to socialize losses while privatizing profits. Regulators searched for a solution that preserved banks without enraging voters. Bail-ins were presented as that solution: elegant, technical, and politically convenient. Instead of taxpayer bailouts, creditors would absorb losses internally. Depositors, legally creditors, were quietly included in this new framework. Shift-while-sputtles, Burian post-crisis reform language few citizens noticed. In Europe, the Bank Recovery and Resolution Directive formalized bail-ins across member states. In Canada, similar statutes redefined depositor exposure during bank resolution. In the United States, Dodd-Frank expanded federal authority to restructure failing banks. None of these laws announced their implications loudly to the public. They were framed as safeguards against future crises, not threats to savers. The first real test arrived in Cyprus in 2013 without warning. Banks closed overnight, capital controls were imposed, and withdrawals were limited immediately. Depositors woke up to discover balances frozen by government decree. Accounts above insured thresholds were partially confiscated to recapitalize banks. Savings were converted into bank equity, trapping depositors inside failing institutions. No crime occurred, no fraud proven, no legal recourse available afterward. Officials declared success because banks survived and systemic collapse was avoided. Depositors experience something else entirely: legalized expropriation in slow motion. The Cyprus case revealed bail-ins were not hypothetical emergency tools. They were operational, enforceable, and politically survivable for authorities. After Cyprus, regulators worldwide studied the model closely. Instead of repealing bail-ins, they refined procedures and communication strategies. The lesson learned was not to avoid bail-ins, but to manage perception better. Bail-ins work best when citizens understand too late to react effectively. Central banks coordinate closures carefully to prevent mass withdrawals beforehand. Once doors close, options vanish instantly for ordinary depositors. Deposit insurance is often cited as protection, but its limits matter enormously. Insurance caps protect small balances, not life savings, businesses, or institutional deposits. Insurance funds are finite, designed for isolated failures, not systemic collapse. When multiple banks fail simultaneously, insurance becomes a political promise, not a guarantee. Authorities retain discretion over payouts, timelines, and emergency restrictions. In crises, law yields to stability, and stability favors institutional survival. Bail-ins also fundamentally alter depositor behavior once understood. Knowing funds can be frozen discourages withdrawals during early stress signals. Fear of being locked inside replaces the instinct to escape risk. This reverses traditional market discipline, where depositors punished weak banks. Now weak banks retain deposits while savers absorb uncertainty silently. Executives often remain protected, while depositors face losses without representation. Supporters argue bail-ins reduce moral hazard within the financial system. Critics argue they merely transfer moral hazard from banks to citizens. Either way, the power imbalance becomes undeniable during emergencies. Most depositors lack access to real-time balance sheet information. They cannot assess bank solvency before restrictions activate. By the time warning signs reach headlines, withdrawal windows already close. Bail-ins are activated during weekends, holidays, or overnight announcements deliberately. This timing minimizes reaction, panic, and capital flight across borders. Capital controls often accompany bail-ins to prevent external transfers. Digital banking makes enforcement easier, faster, and nearly absolute. A frozen account requires no guards, only code and legal authority. As money becomes digital, bail-ins become more efficient, less visible, and harder to resist. Physical cash once provided an escape valve during institutional failures. That valve narrows each year as cash usage declines globally. Digital money centralizes control precisely when decentralized access matters most. Bail-ins rely on this architecture of centralized settlement and custody. Your balance exists inside systems governed by emergency statutes, not personal contracts. Terms and conditions always differ to regulatory authority during declared crises. Courts historically side with stability when financial survival is at stake. Legal challenges after bail-ins rarely succeed, delayed by years and complexity. Depositors discover too late that legality does not equal fairness. Bail-ins reveal the hierarchy of priorities embedded inside modern finance. System stability outranks individual ownership during emergencies. Liquidity outranks consent when collapse threatens. Confidence is managed, not preserved, during institutional failure. This reality forces uncomfortable questions about savings strategy and risk exposure. Keeping money entirely within banking systems assumes permanent stability. History repeatedly disproves that assumption across continents and centuries. The modern system trades transparency for efficiency and efficiency for fragility. Bail-ins are not accidents. They are design features of post-crisis finance. Understanding this design is the first step toward informed financial resilience. Most people never learn these rules until they are enforced upon them. By then, choices are gone, doors locked, and balances redefined legally. The bail-in trap does not announce itself with sirens. It activates silently, lawfully, and permanently alters savings outcomes. And it remains dormant only as long as confidence holds. When confidence breaks, the rules you never read finally apply. Banks rarely announce collapse with sirens. T'introduce temporary measures wrapped in that reassuring legal language. Access limits begin small, framed as stability tools designed to calm crowds before fear spreads uncontrollably. Withdrawals become permissions, not rights, once regulators activate emergency powers written during quieter decades. The lock is psychological first, financial second, because panic breaks systems faster than insolvency ever could. Legal frameworks anticipate crisis long before citizens imagine it possible within modern financial democracies. Resolution regimes exist precisely to override expectations during moments politicians call extraordinary. Circumstances. Deposits shift classification subtly from personal property to liabilities supporting institutional continuity. This transformation happens instantly, not through votes, but through clauses buried inside banking statutes. Most depositors believe insurance guarantees access, misunderstanding what protection actually promises during systemic emergencies. Deposit insurance protects balances, not immediacy, not purchasing power, not transactional freedom during crises. Coverage activates after resolution, liquidation, or restructuring, never during the panic itself. Time becomes the hidden tax, eroding value while officials insist everything remains technically safe. History shows freezes rarely begin because banks lack money. They begin because confidence evaporates suddenly. Banks operate on fractional reserves, meaning deposits exist mostly as numbers supporting loans elsewhere. When many people demand reality simultaneously, accounting fictions fracture under physical constraints. Law intervenes not to protect individuals, but to preserve institutional architecture from collective withdrawal. In Cyprus 2013, deposits were frozen overnight, justified as necessary for Eurozone stability. Account holders woke to restrictions enforced by law, guarded by police, defended by economists. Balances above thresholds were converted into equity, renamed bail-ins to sound orderly. Ownership changed, without consent, yet remained legal under emergency banking resolutions. Lebanon repeated the pattern quietly, without formal legislation, through informal capital controls. Banks limited withdrawals arbitrarily, while courts hesitated, fearing systemic collapse consequences. Depositors discovered Savings were promises, not possessions, dependent on institutional goodwill. Years later, legal clarity never returned, only normalized restriction and permanent loss. Argentina's Corralito trapped deposits behind withdrawal caps, igniting protests and political collapse. Officials claimed necessity. Citizens experienced betrayal, watching savings dissolve through inflation. Courts validated emergency decrees, proving legality follows power during financial distress. Money inside banks became untouchable, while pesos outside lost value daily. Modern banking law assumes deposits are unsecured loans made by customers to banks. That definition shocks people because marketing language never matches legal reality. Your balance is the bank's liability, not segregated cash waiting patiently. In crisis, liabilities are restructured to protect the system, not individual expectations. Resolution: authorities prioritize continuity of payment systems, not depositor, convenience, or autonomy. ATM access, card networks, payroll flows matter more than withdrawal rights. If restricting individuals keeps commerce alive, restriction becomes justified immediately. Freedom loses arguments when stability becomes the metric of survival. Bail-in laws spread after 2008, quietly rewritten across Europe, Canada, and elsewhere. Taxpayer bailouts became politically toxic, so depositors became the new shock absorbers. Unsecured creditors now include ordinary savers, not just reckless investors. Risk shifted downward, while language framed it as responsibility and resilience. Central banks coordinate freezes with liquidity injections, buying time, not solving insolvency. Liquidity supports institutions, not depositors demanding access simultaneously. Money appears digitally abundant, while physically inaccessible, deepening public confusion. This duality sustains calm long enough for restructuring to complete quietly. Digital banking accelerates this process, enabling instant restriction with minimal friction. A keystroke replaces a locked door, less visible but equally effective. Apps display balances without access, creating illusion of ownership without control. Transparency becomes cosmetic when functionality is suspended by regulation. Cash withdrawals become suspicious during crises, framed as destabilizing behavior. Citizens protecting themselves are labeled threats to collective stability. Moral framing flips responsibility, blaming panic instead of structural fragility. Law enforces this narrative, restricting exits while preserving institutional order. Inflation often follows freezes, silently taxing trapped balances over time. Even when access returns, purchasing power rarely does fully. This delayed loss escapes headlines, making accountability diffuse and invisible. The freeze ends, but damage remains embedded permanently. Who escapes these events successfully shares one trait: diversification outside domestic banking systems. Foreign accounts, physical assets, alternative stores of value provide optionality. Not immunity, but flexibility, the ability to respond before restrictions harden. Preparation happens invisibly, long before headlines announce emergency measures. Governments insist freezes are rare, yet history shows repetition across continents and decades. Each time, authorities promise uniqueness, learning nothing from prior precedents. Citizens forget quickly, lulled by stability and convenience during recoveries. Memory fades faster than laws, which remain waiting quietly. Trust fuels banking, but law governs outcomes when trust evaporates suddenly. Understanding this distinction separates belief from preparedness. Deposits function smoothly only while confidence remains intact collectively. Once confidence breaks, rights become negotiable under emergency statutes. The lesson isn't paranoia, but literacy about how modern money actually works. Banking is infrastructure, not a vault, dependent on flows, not storage. Your access depends on systemic permission, not personal ownership, feelings. Knowing this truth early creates choices later, when options narrow rapidly. Digital currencies may accelerate freezes, embedding control deeper into infrastructure. Programmable money enables selective access, targeted restrictions, automated compliance instantly. Efficiency increases, but autonomy decreases proportionally. Future crises may lock doors invisibly, without physical cues. History doesn't ask permission before repeating itself under new technological skins. Only the unprepared are surprised when systems behave exactly as designed. Bank doors don't slam. They fade into menus reading temporarily unavailable. By then, legality has already decided outcomes. Those who understand custody understand power. Those who misunderstand trust lose agency first. And those who prepare quietly rarely need to panic loudly. That is the real divide when banks lock the doors.